Thank you. Going to continue talking about RSPs. So you recall before the break, we talked about contribution limits. It's all based on last year because we don't have all the information yet for this year. So for example, my 2012 RSP contribution limit is based on my 2011 earned income. And you recall that earned income is business income, employment income, income from rentals. 18% of that number, but I'm limited to the annual limit, which in this case for 2012 is $22,970, less my pension adjustment, and that's what I and my employer put into my registered pension plan, if any, in 2011. Again, this is all based on 2011. And my deadline to make my 2012 RSP contribution is?
60 days after December 31st.
Which is March 1st, as I'm sure you've seen on every second TV commercial these days, March 1st, so in 10 days or however many days that is, 5, which means I better get on it. No, I made my contribution last year as I should because the income inside grows tax-free. So the longer I've got that sheltered income, earning compound income tax-free, the longer the better. So the idea is to try to make, I should actually be looking at making my 2013 RSP contribution now, which I can. If I have contribution room, that is, I have an entitlement to make, for example, $18,000, and I don't, I can carry that forward indefinitely. And that might be good, for example, if I'm trying to pay down personal debts. For example, house mortgages, student loans, that type of thing. Or if I think I will be in a higher tax bracket next year or the year after. So that's another reason why I might like to defer making my contributions. If I over-contribute, I'm subject to a 1% per month penalty tax, which is very onerous. So I try like hell to avoid that, except that if I goof up less than $2,000 cumulative basis, they won't penalize me for that. And I think at this time I actually have $200 over contribution. And again, that's not a problem because it's less than $2,000. Everybody okay so far? Yes?
So if you contribute the extra $200 and then the following year you would contribute $200 less, does that bring you back down to zero and you still have that $2,000 playing room, or?
Precisely. So if I'm over in 2011, let's say, and 2012, instead of contributing $22,970, I contribute $22,770, then I'm back to zero going forward, and that's good. Yes?
So does that technically mean that you can contribute $2,000 more than the actual limit?
It does, and a lot of people do that on purpose. I don't recommend it because you never know when you're going to goof up and cause a problem with penalties. But a lot of people do that on purpose. They actually stick $2,000 in there, and that money grows tax-free as well. Again, it's not my thing, but the rules allow it. I'm going to skip forward now to page 324.
Did you actually talk about spousal RSPs?
That's where I'm going.
Oh, okay.
Spousal RSPs are fantastic. So in this tax system where two spouses will undoubtedly have different tax brackets. We're going to learn about tax brackets in chapter 10. But you can imagine that it's possible to have one spouse in a 40% tax bracket, one spouse in a 30% tax bracket, or vice versa. Thinking ahead to retirement, it's possible that one spouse will have a higher pension than the other, in which case it would be great if the RSP money could grow in the name of the spouse with the lower tax rate expected in retirement. In my own household, my pension is higher than my wife's. So whenever I contribute to an RSP, I always contribute to an RSP in her name. It's called a spousal RSP, and it's a legal way that I can ultimately put income in her hands. This is just tax planning. It's not avoidance, it's not evasion, it's tax planning, it's legitimate. So, for example, she's got this RSP account. I'm the person who sticks the money into it, and the money grows in her name. And when it comes out, for example, through a RIF or a life annuity, you recall the methods we talked about earlier for getting money out of the RSP, it's all in her name and it's all taxed in her hands. The other thing is, she's a teacher and she has a registered pension plan. So her employer contributes to that, and she does as well, which means that she's got a pension adjustment every year. So her own ability to contribute to an RSP in her own name is quite low. This is the only way we can put RSP money aside in her name, and it's awesome. It's a fantastic tax planning device, and every couple should look at it. Funnily enough, in the United States, this isn't as big a deal because, believe it or not, in the United States, husbands and wives can file one joint tax return. They combine their income, so the problem is eliminated whereby they pay tax at two different rates. They pay tax at the same rates. In Canada, people have been lobbying for a long time for joint tax returns, but it hasn't happened.
Sorry, if you, not you per se, but if somebody were to do what you're doing and put all of that money into their spouse's name, if they were to later get divorced, how do you, like, there's no way that you can get that money, right?
What happens on a divorce?
Does it go like 50-50 or?
There's rules that sort of, there's probably going to be a settlement, let's say, so we agree on who gets what. And I believe it's possible at that time to take some money out of hers and stick it into mine tax-free. That's what I think. I've never actually had to go there, thank God. My motto is when I leave the house in the morning, I make sure I kiss my wife goodbye. Or else if I don't, I might have to kiss my house goodbye.
Is this spousal RRSP contribution instead of your own or in addition to your own?
This is, let's say, instead of my own. That is, I only have $22,970 worth of room, and I can decide how much to put in my name and her name, but the total is $22,970. Yes?
It says once an individual's total contribution limit has been established, that an individual can contribute all or part of that limit to the RSP of the spouse. Like, does that mean you have to contribute your limit and then you can contribute to the spouse?
No. It's what I just said just now. So my limit, I do the math. Oh good, my limit is $18,000. Then I decide how much I put into my spouse's versus my own. Okay?
I thought established meant like was filled.
No. Not a good word. Calculated would have been a better word. Someday I'll write a textbook. Someday one of you will write a textbook. You'll notice that there's a big-time anti-avoidance rule, which is talked about on this page 324. If I wanted to do something fun, I might put money into my spouse's RSP, take a deduction on my tax return, and then pull it out the next year out of her account, and it gets taxed in her hands. No, there's an anti-avoidance rule, a specific anti-avoidance rule against that. That says that the money's got to stay in there for a certain period of time. If I pull it out earlier than the third year, it gets taxed back in my hands as it should be. So you might say, well, I guess a lot of people do that then. They stick money in there and then hoik it out in 3 years. No, I've never actually heard of that. RSP money is really supposed to be for retirement and therefore permanent savings, and have never heard of anybody actually using that particular move as a tax planning move. Let's talk about investing in an RSP.
Oh, actually, can I ask you a quick question about the spousal RSP? The reason I ask is because I went to the bank last year with a check that had my name on it, but I wanted to make a contribution to my husband's, but not, I wasn't making it, it was his money from our account, which had my name on it, that, you know what I'm saying? And it seemed like, how does CRA know whose money or how you differentiate between who's contributing to the RSP?
We'll talk about that later in this chapter under the attribution rules.
Okay.
So the question is, what's the source of the money? Where does it come from? Does that all matter? Both from the standpoint of contributing to an RSP and perhaps making other investments as well. And if I don't address that very question later today or on Thursday, please let me know.
Okay.
Compound returns inside an RSP, extremely powerful. Page 322, bottom of the page. I make $6,000 a year contribution, which is $500 a month. Depending on my return on investment, I have a gazillion dollars at the end because it grows tax-free, which is great. I mean, it just doesn't get better than that in the Canadian tax system. Problem is, when I take the money out, it's taxable in somebody's hands. So hopefully, as I'm contributing money, it would be good if I'm contributing when my tax rate is high, for example, during my productive years. And hopefully when I'm taking it out, it's in my retirement years when hopefully my tax rate will be lower. Sometimes people get all excited about all the money they've got in their RSP, but if the average tax rate on retirement is 20 or 30%, they really only have 70 or 80% of that money to call their own. The rest actually belongs to CRA. And so it should. This is a tax deferral, not a permanent tax savings. You want a permanent tax savings, that's TFSAs, which we'll talk about shortly. Who can explain to me the rule of 72?
72 divided by your interest rate, using the number of years for your money to double.
Everybody hear that? 72 divided by the interest rate gives you the number of years it will take your money to double. Who knows why this works, but it is so. For example, if my interest rate is 6%, my money will double in 12 years. Were you reaching for a calculator? If I am able to earn 8%, 9 years, 10%, 7 years, et cetera, it just works. The reason that this is important is to help people understand a bit about compounding. Compounding is very important. And for example, people talk about, yeah, I invested in the stock market, I got 10% or 20% return last year. You never hear when they lost 10%, but you always hear when they made 15 or 20 or something like that. Most people these days think that a reasonable rate of return is on the order of about 6% from stocks. And from bonds, something less, maybe 4% long term. So the era of sort of 10, 15, 20% returns consistently is probably not going to happen anytime soon. Now, it is true that sometimes the stock market does go up, but it also goes down. In 2008 or 9, my portfolio went down 30%, 30%, the year before I retired.
Nice.
I didn't tell my wife. And the right thing to do it's a multiple choice test. A, panic. B, do nothing. C, somewhere in the middle. I literally did nothing. I did nothing. Actually, if I had cash, I would have bought some stock because prices were going down. That's, they're on sale essentially, so you buy some more. But I actually did nothing. I was busy at work. I had conditioned myself not to panic in these things, and things came back, and most investors have seen that. I'm going to draw you a chart of what my brother did. So my brother is a doctor, and actually I have two brothers, they're both doctors, they're both radiologists. One lives in Ontario, one lives in Alberta, and they make huge money, and the Alberta guy pays a lot less tax than he would if he were here. The Ontario guy, he's a little bit impulsive. So stock prices are going down, and he sells about here, and he turns that money into cash, so he's lost money compared to where he was. And then he sits out the bottom, and when he's happy that the stock market has come back, he buys about here. So he sold low and bought high. Like, as far as I know about these things, you're supposed to buy low and buy low and sell high. Keep getting that mixed up. Anyway, he got it mixed up for real. So, anyway, people do different things and what have you. But what I want to talk to you about today is that the rate of return you make is not as important as you might think it is. The most important thing is actually setting aside the money in the first place. So actually doing some saving and investing. People get all fussed, they think, I gotta make the best return I can. I don't know why that is, if it's for bragging rights at the golf course or just what, but really the more important thing is to put the money in the first place. So the rule of 72 says that if I can make 6%, it'll double in 12 years, and then it'll double again in 12 more years. So if I put in $10,000 today, I will have $40,000 in 24 years, okay? Inflation. Let's say that inflation is 3%. And again, these are actually common assumptions that financial planners make today when they advise people. They say, let's talk about a rate of return of 6% and inflation of 3% for a real rate of return of 3%. So that $40,000, you recall our time frame is 24 years, 12 and 12. At 3% inflation, the rule of 72 says that that $40,000 is worth only $20,000 in today's dollars. Because at 3%, things double every 24 years, or looking backwards, they're cut in half every 24 years. And if that money's in an RSP, it's also subject to tax when they take it out. The rate of return, I think, only contributes about half of the value. Half of the value is just because we invested in the first place. So you might say to yourself, well, where does investment money come from? I mean, I've got expenses and all the rest of it. And that's a very good question. It comes from a couple of places. First of all, and I know there's a lot of accountants in this room, so hopefully this won't be too hard. What is wealth? Wealth is like equity on a balance sheet. It's like assets minus liabilities. In the case of a personal financial planning situation, wealth is essentially what you have invested plus the rate of return you earned on that. So that's the asset side. So what you've got invested plus the rate of return, minus your debts. And your debts are your house loan and your student loans and your car loans and all the rest of it. If you want to be wealthy, it's all about what you've invested plus the return minus the debts. What's the amount invested? So it's your income minus the taxes you pay minus the other things you spend money on. So consumption, so groceries and clothing and children and all those things. And my suggestion to you is that a lot of people think, well, I will invest this much and it'll grow to this much and compound interest will save my life. And it's really not so. If you do the math and keep in mind the rule of 72, what's important is to have invested this much in the first place. That also reduces your risk for those accounting types who think in terms of risk management and auditing and those types of things. It reduces the risk of bad things happening. It reduces the risk of inflation eating away your money unduly. And it also reduces the risk of losing money in the markets or what have you, because you're not relying on your investments to grow like this and getting into risky investments. If you invest this much, you can buy more conservative investments that are more likely to produce a stable return and a return that's less volatile. Volatility is a big deal in the stock market, including today. I hate volatility. I would much rather sleep nights. Therefore, my investments are relatively conservative. But to do that, I had to buy insurance, by which I mean I had to invest a lot of money in the first place. And the only way to do that was to either have a high income, thank goodness I did, pay the least tax I could, thank goodness I did, and spend less, thank goodness I did. That gave me a large investment, which then I could invest and hopefully grow. To do that, you need to have two things. The first is a plan, and then the self-discipline to execute the plan. And I'm going to talk to you about both of those now. My plan and my wife's is as follows. It's an ongoing thing. We would like to have in retirement, so I'm retired and my wife's not. When she does retire, the plan is that we will have $5,500 to $6,000 a month after tax. That's very specific. And we've got a spreadsheet where it shows what those amounts are. So groceries is this much, and travel and all the rest of it. And we get together once in a while and have a bottle of wine and negotiate. The travel needs to be higher, she says, and the car needs to be higher, I says. And we talk this through as a couple, and it's great. It's not quite romantic, but
That's what the Valentine's Day card is
that's
for.
what Valentine's Day card and the wine is for, yeah. My giant spreadsheet assumes 3% inflation. Right now inflation is under 2%. I personally have lived through 15% inflation, so I know inflation can be higher. And a lot of people who are, I'll say 40 and younger, like inflation couldn't be that high, but I know it can. So I've got a 3% inflation spreadsheet and a 5% inflation spreadsheet. I assume that I'll be able to earn a real rate of return of 2.5%. So on my bonds, I'm projecting that I can earn 5%. And on my stocks, I'm projecting that I can earn 6%. These are nominal rates of return before subtracting inflation. Now you might say, where can you buy a bond right now that is earning 5%? Because GICs are paying, I don't know, 1.6 or something like that. And the answer is that I only buy long-term bonds. I buy bonds that are 5 or 6 years hence, and you finance types will know that that usually equals a higher yield. And every year, some of them mature, and I buy 5 or 6 years again, and every year. It's called a laddering system. So at any given time, I'm only invested in long-term stuff with high rates of return, and I roll them over once a year, and I'll continue to do that. The other thing is this, same brother says, I gotta be hitting home runs in the stock market because I'm 53 and I plan to retire when I'm 60. And I said, you're full of shit. Your investment horizon has to keep you going to whenever you think you're gonna die, which in his case is, I don't know, 90 or something like that. I said, you've got to be investing steadily between now and age 90. You're not just investing until age 60 and then turning that whole thing into cash and then living off the cash. When you get to be 60, the money's got to last you for another 30 years and all of that inflation. That settled him down a lot. That turned him, that piece just by itself turned him into a person who's investing rather than gambling. He was gambling in the stock market, and he had the money to do it. And while it's going great, it's great. Now he's more of an investor. He's realizing that this thing is for the long term. And it's the same deal with my wife and myself. I commended to your reading stuff like Money Sense magazine. And I would also like to introduce you to this book. I'll put it on this thing here. The Millionaire Next Door was written in 19...
I think you only have one lamp on.
96. Yes, I'm trying to turn them both on. Actually, I've got none.
You're none. Well, that explains the picture.
No, it's helpful. I'll figure that out for next time. Let's read you the good parts then. So what this is about is a study that two economists did of who's actually rich in America. 20 years ago, we began studying how people become wealthy. Initially, we did it, just as you might imagine, by surveying people in so-called upscale neighborhoods across the country. In time, we discovered something odd. Many people who live in expensive homes and drive luxury cars do not actually have much wealth. Then we discovered something odder. Many people who have a great deal of wealth do not even live in upscale neighborhoods. What is so profound about these discoveries? Just this. Most people have it all wrong about wealth in America or North America. Wealth is not the same as income. If you make a good income each year and spend it all, you're not getting wealthier, you're just living high. Wealth is what you accumulate, not what you spend. How do you become wealthy? Here too, most people have it wrong. It is seldom luck or inheritance or advanced degrees or even intelligence that enables people to amass fortunes. Wealth is more often the result of a lifestyle of hard work, perseverance, planning, and most of all, self-discipline. Affluent people typically follow a lifestyle conducive to accumulating money. We discovered 7 common denominators among those who successfully build wealth. They live well below their means. They allocate their time, energy, and money efficiently in ways conducive to building wealth. They believe that financial independence is more important than displaying high social status. I love that one. Their parents did not provide economic outpatient care. Their adult children are economically self-sufficient. They are proficient in targeting market opportunities, and they chose the right occupation. That's 7, and I would add an 8th, which is they chose the right spouse. They chose the right life partner who thinks like they do, and so on and so on. I actually wanted to present this to you on Valentine's Day, but it didn't work out. Anyway, The Millionaire Next Door, fabulous not just for yourself, but for your clients someday, to help you understand better what's in your clients' heads as far as financial planning is concerned. So I mentioned self-discipline, and that's what this book is about. And the other part is having a plan. Let's talk about that for a sec. While I'm getting this ready, I'm going to ask you a question. How many of you have ever talked about these issues with your parents? About their wealth or about your wealth? Or both? How many their wealth? How many your wealth? I'm very pleasantly surprised. I think that's an important discussion to have.
You don't have a...
Not yet.
Oh, okay.
Now you made me forget my password.
Sorry.
I tried to talk about this with my father once. And the way I put it was, so he's a mechanical engineer, and he's a really good analyst. He can take numbers and do crazy things with them. And I said, would you ever like to talk about your financial situation? Can I help you with any advice? And he said, no, I'm good. And I said, well, what's your philosophy? Like how is it sort of going to work? And his answer shocked me. He said, I'm going to do my best, and then when the time comes, I'll live off what I've got. And I said, okay, well, you know, if that's sort of good for you and your sleepy nights and all the rest of it, you know, who am I to challenge that? Now, he wasn't a big spender, but he got lucky. He died when he was 67 years old, and then I inherited the job, obviously, of helping my mother with her financial planning, about which she knew nothing. Big lesson for me, always make sure that both spouses sort of know what's going on. That's really important. And what I found out was that they probably didn't have enough money to live on to, say, age 85 or something like that, you know, whatever the normal life expectancy is. Now, my wife, or pardon me, my mother is very comfortable. She's not a big spender. My dad was a bigger spender. And my mother will just be fine. She's 76 years old, and it's all good. And occasionally she scolds me. She reads some newspaper thing that the stock market's down, and I get a phone call. But it's all good. But honest to God, my father got lucky because he died young. And I just hope that you are having those discussions with your parents. I also found out something interesting, which is that my dad, I think, was really afraid of these things. Like, I think he was afraid of having a discussion because perhaps a matter of pride, and by pride I mean maybe that I would feel that he hadn't set enough aside, or that he wasn't doing the right things, or what have you. I actually think he was doing the right things. But there was no discussion, and I remember that to this day. I remember when and where it was. It was in his front yard about 25 years ago, and I remember being shocked at the time, and just am happy to hear that you and your parents in many cases are having these discussions. Now, one reason folks hate this topic is they think it's complicated. And to some degree it is, but honest to God, the math is adding and subtracting and dividing and multiplying. This isn't crazy math like calculus. And I propose that this whole thing can fit on one spreadsheet, and I'm going to show you my idea of what that spreadsheet might look like.
There it is.
Lots of numbers. Let's break it down.
No minuses. Okay.
I gave this presentation to the fourth-year medical students last year. So some of the numbers are a little bit skewed compared to what young accountants and such might be making when they get out of school. And the ages are skewed as well, because some of them don't expect to be earning meaningful income until they're about 35 years old. But where this starts, obviously, is income minus tax, et cetera, equals ability to invest. These tax numbers, they're just estimates. I pulled them off some website. There are so many websites that give you Canadian tax numbers. As we find out in Chapter 10 and chapters following, there's a lot of places where you can get tax information. And I ran this until age 60. I assume they're retiring at age 60, whatever. Some of them have a lot of student debt. I'd like them to start making RSP contributions. You'll notice these are not the max contributions. I'm suggesting they pay down their student debt first. So for example, at 150, that's at $22,970. But I'm suggesting they make only $10,000 for the time being. Then they carry that forward to years when the contribution is $34,000 in their 40s after they've paid down their student debt. So as I said before, if you have contribution room, you don't have to make that contribution now, you can make it later, and that's what I'm suggesting they do here. And we run that all the way to age 60. I want them to do other investing besides RSP for two reasons. First is to have more money invested, obviously, and RSP we're limited to these days about $23,000. And then also they have opportunities to do other types of investing, for example, to earn dividend and capital gain income outside the RSP. It's better to earn that income outside the RSP rather than in the RSP for reasons we talked about before the break. And that is because the money that comes out of an RSP is fully taxable. So if I have a capital gain, I'd rather have that be half taxable outside the RSP. Dividends are the same way. Then and only then, we have net cash that we can spend on groceries, car payments, house payments, etc., etc. And per month, that looks like this. So that takes us to age 60. The RSP contributions that we're making grow. I suggest a 2% rate here. I had to pick a rate, and I'm guessing that these folks will be fairly conservative investors. Actually not a good assumption with doctors, but I had to pick a rate. Just to show how the mathematics works and the fact that the RSP does in fact grow.
So what you're showing there is the compounding of
Yes.
the RSP?
Yeah, so in the first year, 10,000, a bunch of 10,000s, the income is compounding, and therefore the balance grows to over $700,000 by age 60. And then likewise, there are other investments. Grow as well. And here I picked a 2% after tax, which is probably 3% before tax. I'm thinking they're probably earning a higher rate outside their RSP because they're invested in stocks, for example, rather than fixed income securities inside. And assuming a tax rate of X leaves me with 2% after tax. Again, we can put our own rates in here. And then what happens is, as time goes on, and we retire, we start to draw on the RSP. We keep the RSP invested until age 72. You'll recall that it's possible to hold an RSP until after your 71st birthday, and then we have to start taking it out. And I assume that they take it out using a RIF, and I assume the 7% withdrawal, which is actually pretty close to the prescribed rate of withdrawal coming out. And they're also taking money out of their non-RSP account.
Oh, so that's what they're living off of between 60 and 72?
Correct. So they're living here on $80,000 a year, and here they start paying tax. They start taking RSP money out, so they're paying tax on it. This is a before tax number, this is after. I'm assuming they're going to pay about $30,000 tax on the RSP money coming out, hence why that is 50. And they draw that out till age 90, at which time, well, I'm actually not sure what happens, but you have to cut it off someplace. My own spreadsheet says 95. Now, this doesn't keep track of inflation the way I would want it to, etc. It's just only to show people that this whole thing actually fits on one, albeit large, page. And if they want to spend more money, I'm okay with that. Something's got to give though, and they know that they either have to make a higher investment return, or they'll have less money later, or they need to have higher income or something. All these things are interrelated, and the spreadsheet simply shows what the relationship is among all these things. Yes?
Sorry, in column E, there was a point where for the RSP, you could invest 34,000. But isn't that higher than the 22,970?
Yes, it is, but they have a whole bunch of RSP room because they only invested $10,000 in the early years. Yeah.
Okay. And
No.
they can carry it forward.
You can carry it forward indefinitely. Now, I didn't, check to make sure that the 34 is correct for all those years, but you do see that I bounced them back to 2022 at some point. Maybe I did actually check to make sure the 34 soaks up all of the minus 12s. I don't know. I would have to go check. Again, this is only to show you the relationship among the numbers and the fact that it is possible to have a life financial plan that fits on one page. The millionaire next door.
Do you want to put that spreadsheet on D2L?
I'd be happy to put it on D2L as long as everybody understands the limitations of it and doesn't try to give advice or something. But if you want to sit down with your parents and say, look, this is something interesting, we could fill in our own blanks, do our own calculations, I'm happy to do that. But honest to God, as I say, it doesn't, the biggest problem here is actually inflation. So for example, this $80,000, et cetera, we're taking out, those are in age 61 minus 35 is 26 plus 2013 is 2,040 some dollars. You would have to discount those to present value to know how much that $80,000 is in today's dollars. The rule of 72 tells me it's probably only $40,000 of buying power in today's prices.
Which would actually be good to put in your spreadsheet, because when you're looking at 80,000, you're always in your mind thinking it's today's dollars, but when you're looking at it there, you should really be looking at it in that day's dollars.
My spreadsheet has this. This one does not. Again, another limitation of this spreadsheet. I didn't have the time when I was presenting to these doctors, but I made sure I explained to them that inflation is actually their biggest threat. It is not the losses they think that await them in the stock market. Inflation is probably the biggest threat to their buying power over the age 35 to 90 time frame, which is 55 years. Thanks for listening. RESPs. I love RSPs and I hope you do too. Everybody been getting their slips in the mail for all the amounts they have to include in income? So my own kids, we have RESPs for them. Dad, what is this? Why do I have to put this on my tax return? The answer is because I'm contributing to your tuition. So what they have to include in income is the income earned inside the plan, which is great because the contribution came from me. I didn't get a deduction, but the sweet part is they pay tax on the income. Awesome. And they've got tuition credits and all the rest of it against that, so generally speaking, they pay no tax. And the other part is called the CESG, which is a grant that the government kicks in, matching funds up to $500 per year. Honestly, the CESG has probably paid for all their books. The match is 20% to a maximum of $500 a year, as it says in this in the textbook. The only part I want to talk more about that is the on page 326, second paragraph, which is my situation. My kids are almost finished their undergraduate degrees. 2 of them are done, one's still at it. And the deal with my kids is that we would pay half their tuition for their undergraduate degrees, and then they're on their own after that. So I got one kid who's taking medicine, BCom honors MD someday. Another kid who's taking law, BCom honors JD. So they're paying their own tuition. Which means that, I'm not sure they know this or not, but I still have money in my RESP, sort of with their name on it. I can take the capital out anytime, but I can't take out the income. if I take out the income, it gets taxed in my hands, as it should be, and there's a whacking big penalty tax on top of it, which there should be, because the result is that essentially I put this money in there, it got sheltered from tax all these years, and now I take it out and I think I should have enjoyed a tax deferral for 20 years. There's a big penalty to be paid, and I would have to pay it. The good news is if I have RSP contribution room, I can transfer money from my RESP to my RRSP. And that's a good thing. The grant goes away. The grant, which the government kicked into the plan as soon as I made my contributions, and income has been earned on that. The grant goes away and gets repaid to the government, and that's as it should be as well. So the process of collapsing an RESP has a few issues in it, and I need you to know those issues, explained well in the second paragraph of page 326. Tax-free savings accounts. Another fantastic idea. I can put in $5,000 a year and invest it and never have to pay tax on either the $5,000 or the investment returns coming out. And that's very good. I wish it was $50,000. It's not, it's only $5,000. The good news is it's $5,000 per year. And I think the textbook talks about how much we have. Yeah, $20,000. So on the top of page 327 under contributions, an individual 18 or older in 2009 who has not contributed to a TFSA in prior years can contribute $20,000 in 2012. I need you to know that. So it's 2009, 10, 11, 12, 4 years, $5,000.
And didn't it go up this year?
But not in 2012, and this is a 2012.
Oh, but it did, right?
Yeah, I think there's a proposal to go up to $5,500 for 2013.
Well, it's in steps, right?
So, if I earn $1 million on my $5,000 investment, that's all good. That
And unlikely.
comes out tax-free.
So, I actually have a question more like an investment strategy. Would it be wise then, because it is tax-free of capital gains and dividends, to basically like put it into almost junk bonds and play with at least a little bit of the $5,000 in hopes that you get that 25–30% return and none of it is taxable?
A lot of people are doing just that, are purposely taking on more risk because their downside is limited. I lost $5,000. $5,000 isn't a small amount of money, but in the scheme of things, it's not that large to an investor. And my upside is unlimited. So a lot of people are in fact using this for higher risk investments than they might otherwise undertake. Not only that, if I earn $1 million and I take out $1 million tax-free, if I want to, I can put $1 million back in. No penalty, nothing. Important though, I have to put it in the next year, not this year. So, some big computer at CRA is keeping track of how much I take out. And if I take out 5,000 or if I take out $1 million, it's letting me put that back in over and above each year's 5,000 contribution. Any questions on that?
But they do have some way of actually figuring out if you move it from one institution to another, I believe.
This is actually a problem. Because people were taking what I just said, the ability to take money out and put back in with no penalty, or to move it from institution to institution. And CRA said, no, the rules aren't like that. This isn't meant like a savings account where you just have money coming in like daily almost. If you take the money out in 2012, you cannot put it back in 2012. All you're allowed to contribute is your $5,000. So people were getting these penalty notices from CRA. If you Google Globe and Mail TFSA penalties, there are like 50 hits. And this is one of them. This is from September of last year. Letters were sent out on June 1st, quickly generated horrified responses. If you make your maximum contribution and then take some money out in the same year, you have to wait until the next calendar year to replace it. So they were getting penalty taxed. In some cases it was like $100, but in some cases it was hundreds of dollars. And we're talking hundreds of dollars with respect to a plan that only has $5,000 in it. So like, I mean, it's a material penalty given the size of the account in many cases. So I mention this to you both as something I want you to learn for the course. You can take the money out and put it back in, you just cannot put it back in the same year. And for you to let other people know so they don't get in this position as many of these taxpayers did.
So if you had $5,000 and then you took $500 out in 2011, you could only put $5,500 in 2012?
Correct. So it's the greatest thing since sliced bread, as long as you understand what the rules are. The other problem at the time was that the financial institutions, who I thought would have been sort of the gatekeepers of this, they didn't know the rules well themselves. And people would say, you know, I took some money out, I want to put it back in. Of course, the FIs are happy when the money comes back in, and therefore nobody was looking at the rules closely enough. And CRA, for some reason, hasn't sort of relented and changed the rules, or the Department of Finance hasn't yet. Hopefully that'll happen sometime. Meantime, watch out. Yes?
So that waiting to put it into the next calendar year, that's only if you put in like the max contribution for the year, right?
Correct.
Yeah.
If you put in, say, $2,000, and you want to put in $3,000 that you took out last month, that's not a problem.
Did they fix that problem where if you moved it from, say, a stock account to not a bank account, but a different stock account, that it wasn't considered a withdrawal and a recontribution? Because originally that was a problem, but I thought they fixed that.
The problem I heard was not that, but it was putting it in, taking it out of one bank and putting it into another bank.
Oh.
I don't know anything about changing investments within the plan. I don't think that's a problem, and for example, it's not an RSP either. I routinely make changes from one type of investment to another inside an RSP.
So do you know if they fixed it?
I don't think they did.
Oh.
Sorry, can I ask you one more question about this?
Sure.
I think this might have already been answered, but, so you can only have one TFSA per person, right? You can't have it one TFSA per person per financial institution, like CIBC, TD.
You can have as many as you want, but it's only $5,000
Contribution.
in total. Same with RSPs. I personally have RSPs at two different banks.
Okay, but you can only maximum.
Correct.
22.98.
Yeah.
Okay.
Oh, and CRA knows. They know everything. So I can't make, 22 at one bank and 22 at the other. They're smarter than I am.
The attribution rules for the TFSA that they're
Oh,
middle bottom-ish of 327.
so if my wife wants, keep talking about my wife. If I want to put money into my TFSA, but I don't have cash today, my wife can give me money, and I can put it in, and there's no problem with that. There's no tracking as to where the money came from. So another way that we can income split between the two of us, we can have, for example, in our case, it would actually be better in the opposite. If we set up a TFSA in her name and I put the money into her account, that's all fine.
So is this where you're gonna talk about joint accounts and how they know who actually paid for the thing?
I don't think it matters for an RSP.
No?
I don't think it matters for a TFSA either. I personally have taken money from her account to put into my RSP account and vice versa.
Well, the banks seem to think that, well, if I'm contributing it, it's a spousal. And I said, no, it's not a spousal. This is his contribution to his, I'm just the messenger with the check. But the banks seem to want to know, you know what I mean? So there's got to be some box they check off or something. I don't know.
The important thing to a bank is two things. Who made the contribution? That is, who do we make out the tax receipt to? Because
Yeah.
they're going to put that on their tax return, right? They're going to deduct
Right.
it. And in whose name should the money grow?
Mhm.
So you might be the contributor, but your husband's the beneficiary. The money grows in his hands. That's what the banks typically are very careful about. I've never heard of a bank being concerned with where did the money come from. Let's turn to page 328, please. 329, the reasonableness test. Section 67, you know that already, let's move on. Allocation of purchase price for multiple assets. Section 68. All that says is that if you, say, sell your business, and you think the proceeds is this much for land and building and this much for goodwill and all this kind of stuff, and if it doesn't say explicitly in the agreement that each amount is for each of these things, the other party might have a different view. They might say, well, we paid this much for the Class 29 assets because we get a huge write-off on them. CRA has the power under Section 68 to come in and figure out for themselves what they think the allocation is, and make both parties agree to that. So that's what Section 68 is. So it's with regard to the allocation of proceeds among various classes of assets. The way to get around that is just to have both parties agree on what the allocation is, put that in the agreement, everybody signs off, and it's all good. Transactions with inadequate consideration. Please turn to Section 69. Giggity. Except as expressly otherwise permitted, provided in this act, where a taxpayer has acquired anything from a person with whom the taxpayer was not dealing at arm's length. You recall this arm's length from an earlier chapter, which we said a family member is someone we're dealing with not at arm's length. A person who's a friend or a non-relative, that's at arm's length. So if I'm buying or selling something from a family member, I deal not at arm's length. You might say, is that a rule of some kind? Is there a definition of arm's length? Yes. Please turn to Section 251. For the purposes of this act, by the way, that's as powerful as a preamble you'll ever see. For the purpose of this act means for like the entire 3,000 pages or whatever. So this is a really big deal. Related persons shall be deemed not to deal with each other at arm's length. Guess what? There's a definition of related persons. 251 sub 2. Individuals connected by blood relationship, marriage, or common law partnership or adoption. So that covers what we've been talking about, which is, sisters and brothers and mothers and fathers and stuff like that. So, if I buy something from my wife, and let's say that we had real hard bargaining, like real negotiation, just like I was buying it from a stranger, that doesn't count. We are deemed to deal not at arm's length, and Section 69 matters. Let's turn to Section 69 again. While there, please refer to page 330, number 3. Property transferred by way of gift. Property transferred by way of gift is deemed to have been sold at fair market value. So this makes sense. The Income Tax Act says that if my wife gives me something worth $1,000, she's deemed to have received the proceeds of $1,000 even though I gave her nothing for it. That's what Section 69 does. (69) 1B, where a taxpayer has disposed of anything to a person with whom I was not dealing at arm's length for no proceeds. That means a gift. Or for proceeds less than fair market value. To any person by way of gift inter vivos during my lifetime. Blah, blah, blah. The taxpayer, I, shall be deemed to have received proceeds of disposition equal to the fair market value. Okay, so far? Back to number 3. The recipient of the gift is deemed for tax purposes to have purchased the property at a cost equal to fair market value. So the adjusted cost base going forward is also fair market value. And that's fair because in this case, my wife had to pay tax on the $1,000 proceeds. I don't know what her adjusted cost base was, but let's say it was $1, so she had to pay tax of $999, 50% taxable. So somebody paid tax on that $1,000, so it makes sense that the recipient is allowed as their cost base to use $1,000. You okay with that?
It's like avoiding double taxation, like the dividend thing.
It's exactly avoiding double taxation. Because here's what's coming. A lot of people think, I heard this thing that taxes, there's a bad thing that happens. If I make a gift, I have to pay tax based on fair market value. Let's not make it a gift. Let's just make it, say, $1. So you actually buy something from me, but charge me $1. And they think that they're doing something smart because they avoided the tax payable on these proceeds. So they're thinking, I got no proceeds, or my proceeds is only $1, so at least I as the giftor won't pay any tax. What happens here? Fair market value proceeds. The Income Tax Act sets aside the $1. It says, no, your cost base will be, or your proceeds will be 1,000. So whoever did the gifting has to pay tax based on 1,000 proceeds. And the adjusted cost base going forward, only $1. So that if I sell it, if I received it and I sell it the day after for $1,000 fair market value, this person paid tax on $1,000 and I pay tax on $1,000. That's double taxation. That's the result of, I thought I would be cute and avoid a gift. That's the result I get, and that's what Section 69 says. Because it says in B1, or for proceeds less than the fair market value thereof, $1,000. Boom, the taxpayer is deemed to have received proceeds equal to the fair market value. So that's covered in number 1 on page 330. Sold at a price less than fair market value is deemed to have sold at fair market value. No adjustment is made to the purchaser for whom the cost of the property remains the actual price paid. And if I charge, yes,
This is just for non-arm's length, correct?
just for non-arm's length. Thank goodness.
Which is what inadequate considerations means, non-arm's length?
No, inadequate consideration means less than fair market value.
Oh, okay.
Thank you for asking that question. Let's say the consideration is more than adequate. Let's say it's $2,000.
Well, then this section 69 doesn't have this, right?
Oh yeah, it does.
But it's inadequate.
Can't just read the title.
Damn this act.
Number 2 on page 330, property sold at a price higher than fair market value is not adjusted to the vendor. Vendor pays tax based on $2,000 and the selling price constitutes the proceeds of disposition, and however the cost of the purchaser is deemed to be the fair market value, not the actual purchase price. Again, double taxation. This turns out to be a pretty good deal. It's only single taxation. Section 69. If you look at page 331,
Are you going to show us where in 69 it says .2? Or do you want to put it on the bulletin board?
yeah, I'll do that. Please ask that question on the bulletin board and I'll tell you where the cost base. So this covers transactions between individuals. It's important to note the word direct line descendants. If you look at a family tree, so grandfather, father, son, grandson, etc., we call that lineal descendants. And it also covers siblings, for example, my brothers. But it doesn't cover cousins, aunts, uncles, etc. So it doesn't go this way. It only goes this way. in this way. If you'll just gaze at that list of direct line descendants, et cetera, you'll understand what I mean if you draw that picture in your mind. And as I say, an uncle for which I'd have to go like this and like that, so I diagonal, I deal at arm's length with my uncle. Page 331, item D, transactions between individuals.
Do you want us to be familiar with this situation and analysis that they've got on page 330 at the bottom?
Yes, please. Transactions between individuals and corporations. First of all, who are the related parties? Back to section 251. Subsection 2, definition of related persons. These folks are related. A corporation and a person who controls the corporation. A person who's a member of a related group that controls the corporation, etc., etc. Please, as a homework assignment, read 251 bracket 2 with page 331 open in front of you and page 332 where they have these situations where family members own companies. My favorite is structure 2. Person B is obviously related to the corporation under person B, and person B is also related to the other corporation because person B controls both corporations. Person C isn't related to the corporation that she owns 40% of, unless C is related to B. That's how this works. That's actually the most complicated one. If you go through this slowly, you'll get it. It's pretty straightforward. So we're looking at the relationship between the people who are the shareholders and who it is exactly that controls the corporation, and whether the corporation is controlled by this person. If this person is related to that person, everything is related. Yes?
Sorry, I was going to ask you to repeat the section and the page number that you wanted us to look at.
So 251 bracket 2 and pages 331 and 332. Last thing I want to say tonight is when corporations are related, for example, if one corporation controls another, like for example a multinational situation, and you may recall the Starbucks example we talked about earlier on, where there were protests in Starbucks in the UK because it was felt that Starbucks doesn't pay enough tax in the UK. The reason for that is that Starbucks buys goods and services from other Starbucks locations, for example, management fees that the UK company pays to the Americans. Those would be deductible by the UK company and therefore reduce the amount of tax that Starbucks pays in the UK. The question is it fair market value? And there's a whole subsection of tax experts who do nothing but figure out what the fair market value is, the value being added of transactions between multinational companies to make sure that the right amount of tax gets paid in each country. And it's actually one of the fastest growing specialties within tax. I'll be happy to take any midterms for regrading. See you on Thursday.